We'll get this started. We haven't done this in a minute. I just want to start with to thank everybody that's here. This is really just like a state of the union for WFA, kind of fill people in. Purpose of this webinar is not, we're not trying to do anything. We're not trying to make changes. We're really just trying to educate. The firm was built on education, communication, service, and this is the education piece. We're just trying to separate. There's a lot of noise in the headlines. We just kind of want to give our opinions and facts from our standpoint. So it's actually our strategic planning week this week. So if you're a client of ours, we have our entire team, Rick included. Shannon will be here, Jillian. So we'll have 17 people in our office today and tomorrow doing strategic planning for the firm, which I think is important. As advisors, we ask you a lot about your goals and where you're headed and what's working and what's not working and all these types of things. And I just want you to know as clients, like we're doing the same thing on our business. And so for the next 2 days, we'll be asking those same questions of like, what can we improve and what needs to get better, what's working. So that's exciting to have everybody in the office. Another milestone over the last 12 months, and some of you may or may not know this, but when we did our first deal, I guess with Tommy, meaning when he started to retire, we had an outside group that purchased part of the business. Now, they've never been known. They didn't make any decisions, but they were an outside group. And so I guess was it July, I think, Rick, maybe last year, where we officially took back 100% ownership of WFA. And so we were thankful for their time that, they had with us. They played a big piece of that process, but as of about a year ago, we're 100% owned, which is great if I'm a, client to know that, hey, the decisions are being made right here. If you followed anything that we've done the last 2 years, we've spent a lot of time on hiring and trying to train talent. Brandon and Rashad are now two fully licensed advisors with us. They've been with us, I guess, 2 years now, fully licensed. They're handling client phone calls, touching clients, just trying to do more outreach in a time where I feel like the world is less service oriented. We're all on our phones, we're scrolling, we're ordering online and all that type of stuff. So that has worked out great just from a energy standpoint. Those guys are hungry, they're on fire, they're here to serve. I would encourage you, look, there's Rashad right there. Rashad, turn your camera off. Unless you want to say something. So unless you're, Rashad and Brandon have been very good about reaching out. So I would encourage you, if you haven't met them, call the office, ask for Rashad, ask for Brandon, and say, I just want to learn more about you. Get those guys on the phone talking. But we are investing in our team. You've also, because of that, seen some of the athlete posts on social media. So if you follow our Facebook or Instagram or any of the newsletters, you'll notice that we have dipped our toes heavily into the athlete space. From me to you, as our clients who are on this webinar and who will see this recording, we're not changing courses of our business. It's still blue collar, everyday people who are looking to retire. They need income. We want to preserve their capital. It's the widow, it's the divorcee, it's women. Like our main core business is still what it's always been. The athlete channel, we just have expanded upon really naturally. And so you'll see more things coming out about that. We've got a bunch of guys now in the NFL working with us. We've got some NIL in college and high school. That's going fantastic. But I've heard a few times it's like, are we just doing athletes? And that's not the case. We've hired in front of what we saw as an opportunity, and it's been fun moving forward. So I just want to give that confidence that hey, we're not just going to be athlete only, and everybody's still safe from a business standpoint. And then last but not least, we've got a bunch of updates. Not only in the team have we spent some time and money training, we brought a lot of resources to the table from, and I know we've mentioned it, but like the high yield savings account, we can do now in-house wills, power of attorneys. We're bringing tax planning, I think, towards the end of the year, and tax preparation possibly into the office. Mortgages can now be done in-house. So just not that every client needs this, but just know that, hey, we're trying to expand services as a business to help you, our clients, succeed and have access to all this type of stuff. And then in September, a little teaser, and some of you know this. I can't say it publicly, so call me if you want more information. But we've got a big announcement coming in September that we've been working on for probably 10 years, and really strategically the last 6 months. We're very excited about it the week after Labor Day. We'll probably have some communication out to clients maybe the week or two before, but just be excited for September and an announcement that we've got. So that's just kind of a State of the Union. We're excited. Statements will be out for May. Rick, do you think everybody will be happy with their May statements when they get them this week? Or
Lord, I hope they are.
should
So yeah, I don't think you should find anything in that statement that would disappoint you.
yeah.
But yeah, go ahead.
Good. So I'll get started real quick. Rick, if you've not met him or seen him, you probably haven't been around for very long. Rick's our Chief Investment Officer. He is a Harvard graduate, Stanford graduate. He's always the smartest guy in the room. And so we bring him on. Rick is actually in charge of managing the assets. So what makes us a little bit different are a lot of things, but one of them being you've got direct access. And I know some of you on the call, because I can see who's on, have talked to Rick one on one when you have a question. And I just want to encourage you that the number one success factor of investors is not making a bad decision. And our job is to educate and make sure that you feel confident and have the resources to not make a bad decision. And so, first and foremost, I know Rick's on this call, he's on the videos. Please, please, please don't ever hesitate to like reach out if you need something. He's there to answer those. But today I've got 10 questions plus a couple of client questions. And so I'm just gonna get with it unless you want to say anything before we start.
Now let's just roll.
All
I
right.
will just emphasize to Danny's point. One of the things that I enjoy most is actually interacting with clients. So to the extent that you guys have a question about anything that's going on there and you want to reach out, always, always, always feel free. Because it's really, some people are like, well, I don't want to bother you. I'm like, this is literally my job. So, anytime you have a question, just reach out.
Yep. We appreciate you. So I'm going to ask it in a different way, sort of like a question, and then I'll let you answer it. So I'm going to go with question number one. If somebody only watched cable news for, say, the last 6 months, that's all they did, what would they think is happening? And how does that compare to like what the actual data is telling us?
Yeah. I think if you were just watching cable news, you would probably think the world was ending. I am on record multiple times by saying that the cable news services sort of thrive on fear and creating fear because when you're scared, it motivates you to tune back in. And it also triggers a dopamine response when you get scared or angry that then you tune in for the next day because it's kind of addictive. So if you are one of those people that just watches cable news every day, I encourage you to stop because it really actually doesn't help your psychology. It doesn't help you feel better about life. But anyway, if you were watching those programs exclusively, you would be probably very, very focused on politics and what's happening with all of the various, House races and Senate races, and Lord knows there's a bunch of stuff going on over in Texas and everything else like that. You would be focused on whatever is going on over in the Middle East, Iran war, Gulf closed. Is it closed? Is it open? Is it straight open? Is it closed? Where are oil prices? And what is the daily sort of back and forth of that negotiation? And I really don't think, there's a couple of questions that you later on in the chat, but I really don't think that you would be all that focused on how are corporate, earnings looking? How is the economy growing? What does the valuation picture look like? All of those things that I think are more core to how does the stock market perform? I don't think you would be all that focused on. And I think that it's important to remind people, which I know we'll do with some of these later questions, that if you were to sort of ignore what I'll call the superfluous noise out there and just look at where are corporate earnings and where are valuations, you would look at that and say, like, actually, the market actually looks better than it has in a number of years from a valuation standpoint and from an earnings growth standpoint.
Amazing. So let's go to, since you mentioned it, the Middle East. The biggest story, obviously, right now is that you can't turn on the TV at all without hearing about it. How concerned should an investor be? Hey, there's Chris.
Hey,
Can you turn the
Chris,
camera off?
would you turn? Yeah.
How concerned should investors be about it? And like, what are you watching most closely when it relates to that?
Look, I think is it concerning? Yes, in the sense that, the market ignores most conflicts, right? Like almost every conflict, the market is just sort of shrugged off. There's a fantastic chart, which, if you're interested, I can always email, which shows basically how the market has performed despite all of these various regional conflicts. And the reality is the market just kind of goes up and to the right, right? I don't know, in my 10 years here, in my 12 years prior, there's probably been, I don't know, 15 different regional conflicts of some size, scope, et cetera. And the market just goes up and to the right normally because the market doesn't care. In some cases, conflict is actually good for economic growth in the sense that when stuff gets blown up, you've got to rebuild it, and when munitions get spent, you've got to replenish them. And so, there is some element, and I'm not saying this is a bad person, but there is some element of, hey, as the market is going up and to the right, like as these wars happen, et cetera, it creates economic demand, and the market, somewhat likes that. This conflict is obviously a little bit different because of what's going on with oil prices. Impacts everything that we do. And, it is inflationary, certainly, to see these oil prices as high as they are. But one thing that the market is super, super good at doing is not focusing on where we are today, but focusing on where the market thinks we're going to be 6 months from now, 12 months from now, 18 months from now. And through that lens, if you look at the forward price of oil or anything else, the market is basically telling you, like, look, eventually that strait is going to get opened and oil prices are going to start to return to normal. And I'm going to choose to buy or sell stocks based on that eventual state, not based on whatever is going on right now today. And so I think that so long as that is the expectation that eventually these two sides work it out to get the strait open, that the market will continue to be focused on, okay, well, what does 2027 look like? And less focused on, hey, what do the next 3 months look like when we're facing $95 a barrel oil? And there are some nuances to that response, which we'll cover when we get to inflation. But in the meantime, I just tell people, like, part of the reason why the market isn't reacting as violently as maybe you might think it would to, you go to the gas pump and gas costs $4 or $5 a gallon is because the market doesn't expect that price to be in effect 6 to 9 months from now. And so it's looking forward in earnings, not at current situation.
So you mentioned oil prices back to normal, and this is off script from our questions, but what is normal? Like, what would you say normal is? Are we going to get back to where we were? Was that normal? Is it higher than that? Or what is there a new norm?
I think realistically, there's a new normal, but I think there's a little bit of a toss up, right? So oil prices immediately before the conflict averaged about $60 a barrel. If you look at if you look at forward pricing curves today, oil is more like, in the out years, 70s, low 70s a barrel. So higher than it was previously, but certainly much lower than it is today. I think that carries a certain amount of geopolitical risk spectrum with it. And if I'm perfectly honest, I don't know that that's warranted or not. One of the interesting things about this current conflict is what happens to OPEC post conflict, right? Like, it's going to be a very awkward, first meeting when Iran gets to show up as a member of OPEC. and be like, hey, everybody, sorry for attacking your oil infrastructure, right? And we've already seen the UAE, which is, I believe, the world's second or third largest oil producer, defect from OPEC and basically say, like, we're not a part of it anymore. And the interesting thing about OPEC is, you've seen, and I shudder sometimes that the one more reason not to watch cable news is I've seen some people come out and say like, well, this is going to usher in a new era of American dominance in oil production. And like, that's not how the oil market works. The whole point of OPEC was to raise prices above where they would be if we didn't have OPEC, right? Like that was the whole point of the cartel to begin with. It's not like prices are going to be permanently higher if OPEC's not a thing long term. They're likely to be permanently lower. And that, my friends, is actually bad for U.S. oil producers because my sense is that they are much higher on the cost curve than a lot of the OPEC nations. So where oil prices wind up 5 years from now, 3 years from now, that's kind of anybody's guess. In the immediate aftermath of the conflict, I think everybody's expecting it to settle into that sort of $70 a barrel range, which, is a little bit higher than what we had before, but not like, not insurmountable. I'll put it that way.
So what's the story? We talk a lot, higher oil prices lead to higher gas prices at the pump, which leads to inflation, which leads to the Fed possibly not reducing interest rates to try and, keep the economy from just exploding. So let's move to like inflation.
Yep.
How bad is it? When do you think it quote unquote gets better? Or is it better? Is that why the Fed's not really moved? And then sort of where do you see that inflation number being a year from now, 6 months from now? And then the next question, which I'll just ask, is where do you see the Fed going? Not to predict, but like what are they doing, raising or decreasing rates, and what's it based on, and where do you see that headed?
So I think the interesting stats to look at on oil is not just, sorry, on inflation as it relates to oil, is not just the CPI, which is what we all feel, the consumer price index, but also what is known as the PPI, which is the producer price index. So what are manufacturers reporting in terms of their overall costs? And, I'll be honest, the consumer facing side has been a lot more mellow than, particularly ex oil, than maybe I think most people would have expected. So we've seen, a month over month increase of anywhere from 0.3 to 0.4% month over month on price increases in May versus April, sorry, in April versus March, which is really the last time we have a data set, right? Like we don't have the data set for May yet. Look, point three or point four is certainly above the Fed's target that averages to somewhere between 3.5% to 5% a year inflation. So certainly not something the Fed's super jazzed about. But it's kind of manageable. It's like where we've been historically. If I look at the PPI, which is the producer cost index, that's up to like 0.6% month over month, which annualizes to more like an 8% inflation rate, which, the thought process would be that maybe your manufacturers held off on passing prices on to consumers for a little bit of time, as they adjusted to the shock. You don't expect that to continue for very long before producers start to pass that cost back on to consumers. And so there is a wave of inflation that is coming. How the Fed deals with that depends on how long it lasts. In the sense that if the Fed gets the idea that if the conflict's over tomorrow, then I think the Fed might say, okay, look, we're going to wait for these oil prices to kind of wash out of the economy and inflation should go back down and everybody should be happy. If inflation stays higher for longer, I don't think it matters whether it's the war or something else. I think the Fed will move to combat it. Largely because, the last time we had, massive inflation was COVID, coming out of COVID. And there, that Fed waited because they thought that it was transitory and it would sort itself out. And they were, 9 months late to the party on starting to raise interest rates and put the brakes on inflation. And I do think that, unless the war ends reasonably soon, I think that you are going to see the Fed start to get a little nervous about where interest rates are and where that inflation target is going. And I think you may see them start to raise sooner than people think, unless the war ends and we start to see oil prices come down materially.
Yep. What effect does AI have on like inflation? Is it inflationary or deflationary? Like all the AI talk, and I know the jobs market has been stable. Of course, we just got a report today, I believe, or Eric's, something best
Better?
one in so long.
Yep.
But how does AI sort of affect that? And once again, and this is not, as Rick says, we're not bad people, but there's a difference between the economy when it comes to like the way that we invest money on these Amazons and Nvidias and the Walmarts and the Cokes, and those companies are in really good shape. The lower end of the economy is not so great. And so for our job as financial planners and investment advisors is to manage money. And so I think the takeaway that I've at least been trying to explain was like, hey, you've sort of got to separate like what's happening in the real world economically from like your investment portfolio and look at it as these companies are making a ton of money and AI is a big piece of that. Does that help or does that hurt when it comes to the overall inflation interest rate? Does the market correct at some point just because it's not going to be sustainable? Or is this like a 10-year tech's only getting better and AI is only going to get more efficient and make this better?
It's interesting, right? Because Kevin Warsh has actually written a lot about this, about the Greenspan era and, the lack of inflation in the early 2000s, right? So, I think one of the great mysteries, if you will, in economics, and by the way, like I understand that these aren't mysteries that you pick up at the airport and read. They're not that interesting to anybody but me. But one of the great mysteries in economics is if you look at that sort of, golden age in the markets from kind of the 2009, 2000, 10, Great Recession, all the way through, the COVID correction, it was a period of, pretty rapid economic growth, very low unemployment, but also very low inflation, sort of shockingly so. Like inflation just never showed up. And this was despite a whole bunch of people telling you, during the great financial crisis, hey, we printed all this money and it's going to be terrible. It's going to get all this inflation. It's like, no, we actually got a decade and a half of very, very low inflation. And one of the things that I think Warsh believes is that a lot of that low inflation was attributable to the productivity gains that came from the internet, right? Like that you were able to do things a lot more productively on the corporate side, which enabled corporations to lower their cost structure. And then in turn, competition and Adam Smith's invisible hand sort of passed on those price, that kind of flat price level, if you will, onto these corporations. And I think his hypothesis would be that the next wave of that will be AI, that AI will make us all more efficient at doing our jobs. And so you're going to see economic growth, but you're going to see that economic growth come more efficiently, which means that it decreases inflation. And I have to say, like, I mean, it certainly has that potential, to make everybody a lot more efficient and to pass gains on. I would echo your comment, though, that I get that change can be scary, right? Like, and I think that there are a lot of folks out there that look at AI and say, hey, it's replacing these empty entry level jobs. It's replacing jobs in marketing or jobs in graphic design or this and that and the other. And this is not unlike prior, iterations of the Industrial Revolution, if we're honest, right? Like where Jobs were replaced, jobs were outsourced to machines, etc. It doesn't mean it's a fun process socially. I'll just be clear on that. Like it doesn't mean that the workers that used to do that job or that were thinking that they were going to do that job as their future career are super excited about that outcome, right? But once again, as a society, if you look at it from a very top down level and are only focused on the economics, AI is a way that we can deliver, the same amount of output in a more efficient fashion, which ultimately should be deflationary and ultimately should enable us to provide more goods and services to people, not less. And there was an interesting piece out from the chief economist over at Apollo earlier this week, which was basically making that argument that it's like, hey, don't think about it as, uh, tax returns are going to get easier to do. So that means we're going to see, 50,000 less accountants than we have today. Think about it actually the other direction, which is those accountants are going to get so much better at, doing tax returns that you're going to have a lot more people that instead of going to H&R Block or filing it themselves, actually use an accountant's services to get better tax advice. And it is a little bit, I forget the name of the exact paradox, but this does exist in economics where it's like, look, like, the Model T was a fantastic invention. That assembly line process, put some workers out of jobs, but don't forget that a whole lot more people got cars on the other end of it. So don't be too scared of AI. You've got to consider both the good and the bad.
Perfect. And then I'll let you sort of answer whatever I didn't ask on that, and then we'll get to some like process stuff. But what is the media? We know what the media is talking too much about. You can clearly turn it on. What do you think they're not talking enough about? If there was a media channel that was only focused on providing the positive stuff, I guess, what are they not talking enough about on Fox, CNBC, MSNBC, all those stations?
I mean, I don't think that anybody is spending enough time talking about exactly how fantastic the earnings of the S&P 500 have looked this quarter. You've got earnings across the portfolio up 27% year over year. I mean, that is just a staggering. We're not talking about one company,
What
right?
were expectations? Were they like 13? Didn't they like
Yeah.
double expectations?
Yes.
Okay.
100%, you are right. It was about 12 or 13% EPS growth, and these companies are absolutely crushing it. And interestingly enough, if you look at the performance of the S&P 500 year to date, it's up about 11%. If you think about the gap between those two, if earnings are growing at 27 and, my price only appreciated by 11, that means that valuations have actually come down. I'm not going to share the charts because they're eye exams and they get all squiggly lines everywhere and everything else. But, it's you can argue that right now you can purchase the S&P less expensively than really at any point in the past 2 or 3 years, which is something that I think, everybody's focused on what's going on with politics or what's going on with the strait or what's going on over here. And I think people are taking their eye off the ball a little bit around, hey, these companies are growing at fantastic, just unheard of growth rates and they're inexpensive, certainly relative to history. And if you look at their price to growth ratio, it's below one, which is unheard of. It almost never happens. And so, and by the way, the growth of the valuations and, expansion and everything else like that is not in the Mag 7. The Mag 7 is actually underperforming this year, only up about 7%. So for those of you who have buddies who like to, brag about how they just buy the Mag 7 and run away, now's a great time to, stick your tongue out them and, make fun of them. But in all seriousness, like there's a nice story to be told about one, how strong earnings look amongst sort of corporate America, and then two, what the valuations of those companies look like, certainly relative to recent history.
Yep. So that kind of brings me into the next question, which I don't know if you did that on purpose or not, but what opportunities do you see? And this is not like a prediction of which stock to pick, but I remember a year or two ago, I forget, time flies, but international became attractive and you made some changes in the portfolio. And if you look at your accounts, international have done what you thought they would. Where are we now, and what opportunities do you see based on what's going on currently?
Interesting, like international exists as one, I will just say, but maybe not in the way that people think. There's an interesting dynamic internationally where developed ex-US, so think about Europe, think about Japan, think about these sort of developed economies. Um, they none of them really have this whole AI technology boom, right? Like the companies just aren't located there. And so um, developed ex-US is actually kind of underperforming globally. Emerging markets, on the other hand, are absolutely crushing it. And part of this is because for most indices, they include China in the emerging markets bucket. And so if you think about that, China does have AI exposure, seeing a lot of growth, et cetera. So it's performing well. So one of the moves that we're thinking about is whether or not shifting some of our international exposure, not necessarily increasing it, but reweighting a little bit towards emerging markets as opposed to developed international. I think there's some other shifts to think about if you think about like large cap, like mega cap, ultra valuation versus small cap growth. There's this space in the middle that is kind of your mid cap space. That looks very attractive from a valuation standpoint. Sometimes that can be a value trap. So we're evaluating whether or not we want to do anything there. And then the last thing that I would just say is we're always looking at where we should be on the duration side with our fixed income portfolios. Right now, we're a little bit on top of the benchmark in terms of duration. If the thesis holds true that maybe the next move of the Fed is higher as opposed to lower, then we may consider moving some duration a little bit shorter in the portfolio to lessen the impact of a little bit of rising interest rates. But those are the various areas that we're looking at right now.
Yep, perfect. So that brings me into I'm gonna go into Bluemont. And I've got two client questions so far, but we'll get to them at the end, and I'll give you a little their digital currency and gold, and then like the IPO at SpaceX. So a little teaser towards the back. But first, because we're already here, rather than all the technical terms you just mentioned, Bluemont is our investment process. So we have a well-defined strategy. Chase and I have been on the investment committee for, I guess, 6 or 8 years now. So we get a really deep behind the scenes look. Forget the move, small, large, mid, duration. What is the process behind Bluemont, which is just our name that we created? What is your process behind just the simple way that you think about A, managing the money, but B, when you want to make a change? Like, walk us through what that looks like for a client so that there's maybe a behind the scenes look that, these guys just aren't just selling mutual funds or ETFs or whatever. So, like, give me your process if you don't mind.
No, absolutely. Look, hubris is a thing, and humility is a thing. And if you're going to be one of those two things, I'd much rather be on the humility side as opposed to hubris. Um, what does that mean when it comes to investments? Well, from the very beginning, I think, what we try and do is start out every conversation about, hey, I'm thinking, let's take emerging markets as an example. I think maybe we should get some more weight into emerging markets. What if I'm wrong? Right? Like, have I thought about everything? And, have I thought about this angle or have I thought about that angle or have I thought about, whatever it might be? And so, I'm from the institutional side, right? I spent over a decade at Bain Capital. And one of the things that most institutions do to combat that is they have essentially a committee structure, an investment committee that helps weigh in on all the decisions that are made on the investment side. And you referenced, you're a member. I think we have about 10 people that are on our internal investment committee. And anytime anyone on the investment team wants to make a change in the portfolios in terms of how they're managed, or in terms of, we're going to overweight one sector, or we're going to go longer duration, or we're going to do anything to any of these portfolios, we create, a pretty large PowerPoint deck that explains what that case is and why we think it is. And, it's probably 30, 40, 50 pages long. And then we sit down as a group and talk through it and wrestle with it, etc. And then if it is approved, then we will implement it through the portfolios. And then on top of that, there's another layer, which is really, I think, fantastic housekeeping in the industry, which is we have an investment advisory board that sits in judgment of our portfolio decisions about 4 times a year. So we sit down with that board and they go through the investment decisions that we've made, how we're thinking about the market, what our performances look like, et cetera, to make sure that we are, doing the right things, right? I mean, they're there to poke holes, and it's iron sharpens iron, so it's not a soft process. But the whole idea is to create multiple layers of accountability and multiple eyes on the portfolio at any given time. And I just want to assure everybody, like, I may be the face of the investment team, because to put all of us in one room in a webinar would be really, really difficult to do. But there's a huge crew of people that assist with every decision, every trade, every investment that's made on your behalf. There's probably, once you start to think about, the folks that help us out on the ETFs themselves or on the investment vehicles themselves, and the people that help us out with trading and portfolio construction, everything else like that, there's probably 20 or 30 people all told that get together to work on providing the investment solutions that we provide. And so while it might just look like me in a podcast studio, or in this case, me in a hotel room, it is a large cast of characters that are, there to sort of provide the assistance and support that you need.
Yeah, and so I'll sort of give you your crown on that. Most of the team are excellent. They're all excellent at what they do. But they love the stock market and trading and charts and numbers. And if we put all them on a Zoom, I'm not sure it'd be the most exciting thing. You're definitely the one for that. So and then full disclosure on the investment committee, I remember, and this is off script, but we were in that whenever we went maybe 10% international to 15% international. We're busy and we got this investment committee call. We get on and we go through like 30 minutes and 40 slides. And at the end, it's a 5% move in the stock portion into international. I'm like, do you have all this? You got 40 pages for us to move 5% of the stock part to, yes, we approve, so it is definitely a process, and it's fun to be behind the scenes on it. Two client questions, digital currency and gold. So I got a question. How do you view Bitcoin? How do you view digital currencies within a portfolio? Speculative, like outside of a portfolio that you design? Like, where's your thoughts on, let's just say Bitcoin in particular, because we know that term. And then is the dollar going away? Like, is digital currency taking over? What are your thoughts there?
Here's a quick thought, which is these are products that, in my opinion, are typically sold. So gold, silver, Bitcoin. It's funny, I was on a plane flying home from Miami like about a week and a half ago, and I pulled it up. It was a Sunday morning, and I'm not kidding. There was 4 hours straight of programming on CNBC that was all advertising for either gold or silver. And I'm just going to tell you, and we'll get to this when we get to the SpaceX IPO. If you see it advertised on television, it's probably a bad investment idea. I'll just throw that out there, okay? I'm going to share my screen really quickly because I think it's important for people to understand. Most people, when they think Bitcoin or gold or silver, they think safety, they think stability, they're worried about bonds, they're worried about the market. This is a graph of these prices over the past year to date. And you can see, hey, Bitcoin down here is down 25% year to date. Bonds are flat. Gold's up 3.4 and silver's up 7%. And, the S&P is up 11. But what I think I want you to look at is look at the volatility of these lines, right? Like, the S&P 500 is the purple line, right? Like this one right
That's
here.
the one everyone's scared of.
Yeah, that's the one everyone's scared of. And then, the gold and the silver and the Bitcoin are the ones that are just like wild volatility all over the place relative to the stock market. And by the way, if I back that out, I'm going to show you a 3-year chart of it. Once again, like the green and the like cyan here and the blue, these are all wildly volatile securities relative to, your kind of boring old stocks and boring old bonds. And so I'm not going to tell you that you can't own gold or silver or Bitcoin. But what I am going to tell you is understand that when you're buying it, you're not buying something that's going to reduce your volatility. You're buying something that's actually going to add to it in a material fashion. And for most retirees, I hate to say this, low volatility is actually more important than absolute return level, right? Because when we're making withdrawals out of a portfolio, if I have to withdraw when the market's down or when when my gold is sold off by a lot or when my Bitcoin is sold off by a lot, it doesn't help me. And so I would just note, it's like, look, like if you want to take a little bit of money and speculate in one of these things, then okay, fine. But understand that that's what it is. It is in no way, shape, or form decreasing the volatility of your portfolio or adding a measure of safety. Those are wild myths that the advertisers of those products would like for you to believe.
And then the last question was on SpaceX, which is the IPO. I'm not even sure when. I know they filed, but I'm not sure what the date is. It's one of the most talked about companies probably to go public ever. It's going
Yep.
to definitely be the largest valuation wise. What are your thoughts around not just SpaceX, but like IPOs in general? And an IPO for the clients on the call, that's when you're a private company and you become a tradable security that we can then invest in your Charles Schwab account or your Fidelity account. So whenever that process happens and you go from private to public, what are your thoughts there?
Okay, so the last time that we saw a whole lot of IPO frenzy, right? Like, I need to get in on the next hot IPO, was the dot-com bubble, right? For those of you who remember that, that was the last time I was getting phone calls from people being like, how do I get a hold of the next IPO? And just for reference, that didn't end well for folks. An IPO is a structured sale of a company from the private market to the public market. So, all of their venture capital sponsors and the company itself is looking to sell a portion of the business out into the public markets. And let's just be clear, the venture capitalists and the private equity firms and everybody else like that that own SpaceX are not looking to give it away for free, right? They may want to price it at a little bit of a discount to whatever that fair market value might be, but they're not like, oh, you know what we should do? We should go make a bunch of internet millionaires by pricing this well below the intrinsic worth of the company. That's not the way the IPO market works. And I just think that if you're excited about SpaceX, then that's amazing. If you're excited about the idea of establishing a colony on Mars, or providing internet service, via satellite to all these places that don't have it, et cetera, and you think that that's like the wave of the future, then great. You should wait a couple of days after the IPO for the price to kind of find its level and then buy in and own it for the next 5 or 10 years, right? Because that's the way that true wealth is generated in the stock market. If you're interested in SpaceX as a get rich quick scheme because you think you're going to buy it at the IPO and make 50% in the first day, I just get rich quick schemes rarely work, like ever. We had a similar IPO for a politically oriented company a couple of years back where we had a client that insisted that they buy at the open. And we tried to buy at the open and got best execution we could. And they wound up losing 40% in the first day because everybody was trying to buy at the open and they bought at a very, very high price. And they have never since recovered from that loss. This is one where I would just encourage you, like, please don't buy the get rich quick hype. There is almost no get rich quick scheme that is actually a reliable generator of wealth. If you are interested in SpaceX, wait a couple of days for it to find whatever its market clearing price is, and then let's invest and see where the company goes over the next 5, 10 years. But please don't think that the IPO market is some sort of lottery ticket that you're somehow missing out on.
Closing question. You've been in the business 20 to 25 years. A lot going on. What's your takeaway? What should everybody remember? And I know what it's going to be. Stay invested, rebalance, diversify, all that type of stuff. So give me something, one quick, like client goes to the golf course and their brother-in-law says, "Can you believe this? What can they tell them?" And what's that
Pigs,
information?
I'm going to go with pigs get fat and hogs get slaughtered. Okay. Like your inclination, you actually said it exactly correctly at the beginning of the webinar, which is the number one thing that you can do to not, all right, sorry, to improve your performance in the market over time is to not make big mistakes. I was about to say to not do dumb
Yeah,
things, but
that's
to
right.
not make big mistakes. Okay. And I am a firm believer in this that the worst thing that can happen to you as an individual is to have one of your friends go to a casino and win a bunch of money, right? Because your friend is going to talk to you about it, right? Like they're going to sit there and be like, "Oh my God, I went to the craps table and I made, 70 grand or whatever it is, 7 grand. I don't know how much is a lot of money for friends, but, like I made all this money and it's great and we should go down there again." And it's funny because people in that scenario, we're very bad intuitively at probability math. Okay, one, like we all know that if we go to the casino, we're probably going to lose money. But somehow, like our brain triggers this sort of hope response that we're like, "Oh, I can do it too," right? And the other thing that I would just layer in there is that people don't talk about their losses, right? Like people, your friend who won $70,000 at the casino will be talking about it at the bar. "Man, I got on this hot streak and blah, 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 blah." If that same friend lost $70,000, you will never hear a word about it, right? And this is the scenario where I just encourage people when you think about a SpaceX or when you think about a Bitcoin or when you think about gold or whatever it is that you're thinking about investing in, there is no such thing as a free lunch. There is no such thing as a get rich quick scheme that works. And the vast majority of those types of programs will actually wind up losing you money over the long term. So don't be tempted by it. Like you're smarter than this, right? Like if there was a way that everybody was making money, like it wouldn't exist. Because everybody would try and do it. So just please, 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 like stay the course and don't fall for snake oil sales.
Perfect. I appreciate you being on the call. I appreciate you being in the office. We're going to be hard at work in this office. All the clients, everybody that's on the phone, everybody that sees this recording, we appreciate you. We got your back. We're happy. We're excited. Everybody's in great spirits. The company's in great shape. Life's good. Go out, have some fun, enjoy the week, enjoy your kids, enjoy your grandkids. Like do something nice for somebody, right? and just know that we got your back. So, Rick, I appreciate you. And if anybody has any other additional questions, always feel free to just give us a shout. Rock and roll. Appreciate you, Rick.
Thanks, guys.
All right,
Bye.
see you. Bye.